Well, I do think it's a good deal for Morgan Stanley and for E-Trade now because it's a good strategic fit. Like Mr. Gorman said, the wealth advisors, they can get referrals. E-Trade has a big corporate stock plan business that they can refer these customers to. And also, the Morgan Stanley didn't have, they had bought Solium a few years back, so they're adding to this corporate stock plan business as well. So a nice strategic fit. It might have been done or, earlier before the zero commissions, but it is a good deal between the two companies.
Morgan Stanley shares are down about 4%. One of the critics of this is Mike Mayo, who downgraded the shares to equal weight this morning, and he said that there's a lot of operational risks. It's not necessarily the best strategic fit, that he prefers Goldman's kind of invest to build approach versus splashing out $13 billion from Morgan Stanley. What do you make of the merits of that argument? And is Morgan Stanley making a good case for itself if you consider that it's outperformed Goldman by 2x over the past 5 years, and that Goldman now appears to be chasing the consumer business that Morgan Stanley's long now been in?
Well, what they don't get if they try to build it organically is E-Trade has this corporate stock plan business. Like I said, it's about over $300 billion in assets. So that gives Morgan Stanley access to clients where E-Trade's managing, whether it be a bunch of the S&P 500 corporate stock plans. When they award stock to their employees, they have E-Trade accounts. So before, when they'd cash out, they wouldn't be able to go to an E-Trade advisor. E-Trade was trying to build that. So Morgan Stanley gets that business. They've already worked at that business or started inroads with Solium. The other thing that they get with E-Trade is E-Trade's built a lot of the digital capability, whether it's E-Trade, whether it's banking, robo-advising. So it immediately, catapults Morgan Stanley up to the most modern technology, backbone in the retail brokerage industry.
Dom, it's also the second big merger now for these trading platforms because TD
Sure.
Ameritrade and Schwab have this deal underway. Any antitrust concerns that you might foresee, or how do you think it changes the landscape in general for these trading platforms?
For this particular deal, it doesn't seem like it's going to be a real problem with antitrust. I mean, with Schwab and TD, you could have made that case. But again, like Rich said, in a zero commission world, it's hard to argue that the consumer is being disadvantaged by this because they're not paying anything for commission trades in this form anyway. The interesting part about the Schwab side of things with TD was one of the big things that Schwab had going for it was able to take on deposits. It had a stable money base, a funding source. They had interest margins to make there. TD Ameritrade didn't have as much of that, but it was complementary. Here, Morgan Stanley gets that more stable deposit base from E-Trade taking on some of those deposits as well, and so it gets a more stable capital base there. What I think is interesting about this whole landscape is it's part of this, what I've been calling the retailization of financial services globally.
Can we even call it Wall Street anymore?
It's not even just Wall Street. Yes, UBS and ING. So just today, UBS says that Sergio Armati is stepping down from the CEO role, a global Swiss banking giant with wealth management for high net worth and ultra high net worth. And who do they tap to run it? Not a wealth management person, a guy who's done retail banking and insurance at a Dutch lender to come and do that sort of thing. Because why? He has experience with taking on deposits, also with the digital and financial technology side of the business. Remember, ING at one point had ING Direct even here in the United States.
Sure, yeah.
So there's a lot of retailization. And it's, remember, Goldman's got the Marcus Savings platform now. And so all of that's happening at the same time.
And so, Rich, that's why I do wonder if traditional Wall Street's been shrinking, this business is growing. What should Goldman's next move be? Do they look at one of the other platforms? All those stocks obviously are trading up today, perhaps in the hope that someone else might be the next acquisition target. Should they look at a startup like Robinhood? Do they kind of need that at all, or should they stick with what they've been doing?
Well, I think the other assets are trading up, but to acquire something else right now is going to be expensive for Goldman. So I think Goldman has probably made the biggest inroads digitally of the big banks from a retail standpoint. So if I were them, I would continue on. They've made good progress with Marcus, consumer lending. They're working on an institutional platform as well. So they've made pretty good progress so far, where, again, like Morgan Stanley, this will catapult them and get them that capability pretty quick.